Hello and welcome back to the Subtle Investor. I have read over 100 research papers across both the buy side and the sell side on top of my own work, and for once I am seeing a general agreement on the direction of travel for the stock market returns this year. And I will share with you exactly why we are expecting a much lower stock market return over the next 1 to 2 years and how best to invest in this climate of high inflation, high interest rate and higher taxes. Before we start, let's be very clear that no one can predict whether the stock market will end positive or negative at a given point in time. Mathematically though, there is a 50-50 chance of it going up or down every second the market is open. But over the long term, it has generally trended up. Although we cannot say with certainty exactly what the stock market return will be this year, but our job as strategists is to analyze all the moving parts of the market, starting from the fiscal side, the capital, the monetary and the political outlook, and simplify them so that we can come up with rationale behind why we think the market is heading that way. We did not see 2020 coming. It was a black swan event. But 2022 returns will be quite interesting as there are a lot of visible themes that will drive the market this year. So to understand how the stock market will perform this year, you first need to understand what is the business cycle and how that works and how it interacts with the stock market cycle. The business cycle is an oscillating graph that is plotted against time on the x-axis and the economic growth or GDP in the y-axis. In simple terms, GDP puts a number to the value of a country. You add up consumption of consumers like us, investments made by companies, government expenditures, and net import or export. That number basically tells us whether we are exporting more goods from outside of our country than we are importing. And the reason why I am focused on this is because there are 4 main stages of this business cycle, and the stock market will return differently depending on where we are in that business cycle. And these 4 stages are recession, recovery, growth, and decline or slowdown. If we observe the business cycle right now, we are currently here at peak. We had a short recession in 2020 and then a very sharp recovery during which the stock market returned one of their best historical performances, with S&P 500 up over 21% last year. And now it sure appears that the business cycle may have peaked. This means economic activity will start to slow and the market should not be expecting high returns. Let me simplify what that means by looking over what has actually happened over the last 2 years, because that will hold the key as to what is likely to happen over the next couple of years. Thanks to the extreme amount of support from both the government, we call that accommodative fiscal policy, and the independent central banks, we call that accommodative monetary policy, we the consumers were taken care of during the dark days of the pandemic. Let me be clear, this was not done because the governments or the central banks, they actually care about us. It was not done as a personal favor, but because it's something that they had to do. You know why? Because you and me, we are both super important to this GDP number or the GDP formula that I have just showed. It is estimated that private consumptions made by us account for roughly 60 to 70% of an advanced country's GDP. So if you are not happy or if you are not taken care of, it will ultimately end up as a huge disaster in the history of politicians and the independent central bankers.
He's looked after his own pocket. I still refer to him as Georgie Dale.
So in a nutshell, we just had to be taken care of by whatever ways and means that was made possible. On the flip side, others who were actually fortunate enough to hold onto their jobs saved a lot of money because there wasn't really a lot of opportunities to spend those money. This improved a lot of households' financial situation or the amount of savings that they've had. I mean, I saved under £200 per month just by not having to travel in the city every single day. So strictly speaking, in financial terms, the pandemic had some sort of silver lining for a lot of people who managed to actually save or invest more than they could have. However, the side effect of lower consumer demand meant that alongside the fact that people were getting sick and couldn't come to work, factories had to shut, and that was pretty much what was happening during the whole of 2020. But as the world got vaccinated and the consumers came back to spend more money, the shops and factories have started to reopen again. This means demand for input products that gets used in production, such as semiconductor chips and commodities, including energy, have come back in high demand. This has naturally put upward pressure on their prices. Talking of energy, it is not only an important element for factories, but also a key component of CPI, or consumer price inflation. A big part of the high inflation number that we have been seeing over the last couple of months have in fact come from this energy price increase, which is up over 400% since the 2019 level. Basically, a sudden release of this pent-up demand has pushed our cost of living higher, with inflation in the UK running around 5% so far, and in the US it is as high as 7%. So far it's all making sense. But even as inflation has been rising, the fact that COVID has not gone away meant that we're still faced with a lot of supply chain issues. And companies are still facing problems with sourcing input materials. So again, there are more added pressure on prices paid by the manufacturers impacted by supply chain. Basically, cost of production for these companies are increasing. But remember that companies, manufacturers, they're all corporate, and ultimately all they want to do is maximize their profit. So when the cost of input or cost of production goes up, it will naturally squeeze their profit level, and they have no interest in doing that. So what they do, which is quite obvious, is increase their output prices. That's the prices that we ultimately pay as consumers when we go out to shop. But that does not make us happy though, does it? Because with the same level of wages that we are making, we are having to pay more for the same product that we usually consume. So what do? We go back to our employer and demand for more pay because we want to maintain our current lifestyle and cost of living, which is good for us because higher wages means at least we can consume as much as we would like to. But remember, our wages is again a cost to employers or the companies, which means they again have to increase their prices in order to keep their profit level the same. You see what's happening, right? It's going round and round in a vicious cycle. Economists like to call it the wage price spiral. Ultimately, if we let this continue, it will be detrimental to our economy because then inflation will be completely out of control. So this is what's happening now as we speak. The latest development on price pressure is finally making the central banks more and more nervous. After all, they thought all this pressure will disappear within a couple of months.
Our best assumption is that inflation will return to its target.
But it clearly has not. This is quite embarrassing because the main job of these people is to keep prices stable and under control at around 2%. And so the awkward policymakers like the Bank of England feels forced to hike interest rates to calm inflation. Although rising interest rate is expected to tame inflation, it is a great cause of concern for the stock market. With interest rate increasing, investors who invest in the stock market start to get nervous because when they update their valuation models with a higher level of interest rate, suddenly the high stock prices no longer justify the amount of return that they will likely get back from those investments. So instead of overpaying for these stocks, suddenly investing in the mellow bond market, which are generally less risky, starts to look much more attractive. And not just from the valuation perspective, rising interest rate also makes the investors quite nervous about the side effect that it will have on companies. A higher interest rate will likely make it difficult for businesses to do capex, basically invest in their business to grow. It may also make it harder for them to make their contractual payment to the bondholder, so people who actually lend money to these businesses to help them grow. And outside of these businesses, a higher interest rate will also make financial conditions quite difficult for the consumers as well. And that's because people will be less inclined to make big purchases and instead save more. Less purchase equals less revenue for companies, especially the companies whose products are not seen as a necessity by consumers. Those companies will take the biggest hit. So less consumer spending, less corporate investment, and look, suddenly we roll down on this self-fulfilling prophecy. And while all of these dynamics play out, I want to be clear that it does not mean we will have a free fall in the stock market, but we should expect higher volatility. A high amount of stock market volatility will definitely be here as market participants will keep on updating their views about the market as we move along this process. They will look out for what the central bank, like the Fed, is hinting and what the month-on-month inflation is printing. They will also look out for other important data such as consumer spending and sentiments. While all of this looks rather gloomy, we haven't even discussed all the unexciting stuff that the government is also planning to do this year, so the fiscal side of things. For a lot of people, the government seemed to have saved the day with their furlough program, business loans, and even cash handouts. But those money did not come out of thin air. They were borrowed. And since the economy came to a standstill in 2020, during COVID, source of government revenue was naturally lower, but expenses higher. This only means that the government debt has been ballooning up. By how much? Well, it's been reaching as high as the World War II years. It doesn't really look good for the governments, does it? The fact that they can't really keep to their own budget. Especially when elections come, the opposition party will definitely pick on this point as weaknesses. So something needs to happen rather soon. And the government right now sees it as a perfect opportunity to do just that. The government needs to balance the books. But they won't go back to the failed
Austerity
that we had in the UK post-GFC. Instead, they're looking at things like hiking the corporate tax rate, hiking the council tax rate, and keeping the income threshold the same for the employed. We can expect more clarity on this when Mr. Sunak talks about it in his spring statement. But ultimately, what we all know so far is that the direction of travel for fiscal landscape is tight. And that too on top of a tightening monetary landscape. But how does all of this affect the stock market? Let's look at it from a business perspective. Higher taxes are no good for both the consumers or the corporate. It leads to reduction in consumption and reduction in profitability. And this time around, we have another lingering problem, which is the higher inflation. And that really complicates the picture. That's because the fact of the matter is, if our consumption power remains weak because of this tightening fiscal and monetary policy landscape, while inflation remains high, then even if the companies wants to pass on the rising cost of production to us, the consumers, they clearly won't be able to do so because we clearly won't be able to afford it. So ultimately, it will end up squeezing their profit margin, impacting the stock price. With the already high stock market valuation that is looking at ratios such as PE numbers, what we're basically left with is a tough and volatile ride in the stock market. But I want to be clear, there will be winners and losers in this volatility. I want to share this graphic with you, which highlights how different sectors of the stock market performed over history during this time of decline or weakness that we will be going through. This looks back at the average return from 1960. So we have about 11 declines or slowdown in this dataset. Focus on this row here. Average period return. Notice that on average, returns may not have been very high during this decline phase, but they indeed have been positive. And also notice that certain sectors did marginally better than the overall market. For example, healthcare, financial, and consumer staples did a lot better than real estate and materials. Why? Because these are the necessary products that I was talking about earlier. By consumer staples, we are talking about the likes of groceries, for example, Tesco. Because even when inflation is high and we feel the squeeze in our purchasing power, we're not going to stop going to our usual groceries and buying our usual milk and bread. Similarly, with financials, especially the banks, higher interest rate increases their profitability, so they also tend to perform better during a rising interest rate scenario. So all of these moving parts brings me to highlight the main reasons behind why we're likely to see a much lower stock market return over the next 1 to 2 years. Low economic growth due to tightening monetary and fiscal policies, higher inflation due to supply chain issues and strong labor market, higher starting valuation of the stock market itself, which is impacted by rising interest rates. Plus, let's also account for the unforeseen risks that are skewed to the downside, such as geopolitical tension and re-emergence of another deadly COVID variant. Having said all that, what's the best course of action for investors? Dollar cost average. This strategy especially works best during a high market volatility. And number 2, diversify. Diversify across asset class, geography, style, and sector. Because remember, regardless of where you are in the business cycle in the country that you live in, it is not going to be the same place for another country. For example, did you know that while the US is expecting to rise interest rate and while the UK has already increased their interest rate, in China, they have cut their interest rate. That means they're going for a more accommodative monetary policy. So a good level of portfolio diversification should help you to get the maximum amount of return that you can possibly expect during this slowdown or a downturn. And as the saying goes, if in doubt, zoom out. That's all I had for today. Until next time, do look after yourself and your money.